Farming today doesn't always feel the same way it used to. Then again, some of it feels all the same. Maybe it isn't so much the jobs that changed, but how they get done. Now that's a different story. Efficiencies are critical, which is why you need a lender who will find the right loan structure for a strong financial future. You need a lender to look out for your whole farm operation. Ag Country.
As we kick this off, we're going to cover today what farmers and ranchers can do to manage through a period of time where inflation is creeping up. We all see that and hear it in the news. And of course, the Fed is working to combat that through raising interest rates. So we're going to do a little bit of a deep dive into that. But before we really get started into that, we're excited to be here. We're excited to be a part of the show. We think there's a lot of opportunities for producers across Minnesota and North Dakota. We'll get into talking about that. So before we go there, in Minnesota and North Dakota, there's some fun facts, I think, that just sort of set the stage on what we're seeing in agriculture and how big of a part Minnesota and North Dakota is to that. So I'm going to read some of these so I get them right. But in the state of Minnesota, 1 in every 5 Minnesota workers has a job that's either directly connected to agriculture or indirectly connected to it. So you think about how many people in the state, both states really, that are connected to agriculture. It's pretty impressive. It's a pretty big economic driver. Minnesota ranks 7th nationally in egg production in terms of cash receipts. Minnesota also ranks 2nd in production of swine, the hog industry, if you will, so pretty major player there. And of course, we see a lot in that swine industry in southern Minnesota especially. And we're hearing that there may be some opportunities here in North Dakota with the soybean crushing plants that are coming online. So that's something to watch for. Minnesota happens to be the #1 producer of turkey, poultry industry, and they're also #1 in the sugar beet industry. So Minnesota's a big player. So we cross the Red River, and we think about what's happening in North Dakota. North Dakota generated $7.3 billion in cash receipts through the ag industry. Again, when we think about business economics and what drives our states, North Dakota is a huge player, and agriculture is a huge piece of it. And again, the highest valued crops in terms of cash receipts in the state of North Dakota have been soybeans, wheat, and corn. North Dakota is the home of 26,000 farmers and ranchers. I think that's interesting. There's a lot of people that are in the production business. Ranks 3rd in sugar beet production and is #1 in all of these other commodity groups, if you will. So honey, canola, pinto beans, rye, flaxseed, and durum wheat. So you think about North Dakota and the important role that the state plays in producing those products for our country and the world. I think it's pretty amazing. We know that all of us are a part of an industry, again, where we're feeding America, feeding the world, and that's why I'm excited to be a part of it and happy to be here. So, again, we're going to talk a little bit today about, our part of that and give insights from a lender's perspective on what's happening with inflation and with interest rates, and really around what you can do about that as you manage your farm. So it's going to be some deep stuff, and Jared's going to help me kind of walk through some of the graphs and charts and statistics. He's a pretty smart guy, and you're going to find that out in a minute. I can promise you that when we talk about inflation and we talk about interest rates, those are kind of boring subjects. They're not exciting. Nobody really wants to talk about them, but gosh darn it, we need to really be aware of what's happening and how those things can impact us on the farm. So that's what today is about, providing as much insight as we can around those two areas, and then really we're going to hone in later on what we can do on the farm as we move forward. So we're going to cover 4 topics. One is the root cause of inflation from our perspective as a lender. Again, we'll get into that and talk about the pandemic, the war with Russia and Ukraine and everything that's happening there. We're going to talk about the purpose of the Federal Reserve, just to bridge and bring an understanding of why they're increasing rates. What's the purpose of that? What is the Fed mandated to do? So we're going to cover that. We will review the historical interest rate trends. This gets into some graphs, and for some of us, that's boring stuff, but it really gives insights to what we can expect in the future. I think you're going to hear that interest rates are going up, but if you look at a graph, they're pretty low. If you look back 30, 40, 50 years, we're in a pretty darn good place. For young producers, if you've been in the business for 10 years or less, this is the first time you've seen rates go up. And Jared's going to walk us through a period of time after the housing crash, the housing bubble, 2008 through 2018, where the Fed funds rate got near and at zero for a long period of time. We've never seen that for all the data history that we have. So that's something that's kind of interesting and different. And lastly, we're going to discuss strategies that we can take on the farm to help manage the risk of rising interest rates, of inflation, and do what we can to continue to be able to do what we do that's so important as we think about producing food and fiber for our country and for the world. So I think that's stuff that matters. My name's Troy Andreessen. I'm the Chief Marketplace Officer at Ag Country. I've been a part of the Ag Country team for 23 years, and I absolutely love working for the association. Of course, we're a farmer-owned cooperative. We work with members across all 3 states in North Dakota, Minnesota, and North Dakota. I've got 30 years experience in the lending business. At the end of the day, most of my time was spent as a loan officer, meeting with producers at the kitchen table, in the shop, and talking to them about managing their farm finance, making decisions on what they can do to pass that farm on to the next generation and how to get through the next year. We start thinking about conversations around buying land. What is that going to do to my financial position? Is it feasible? Is it good for me? And that's what I love about what we do. So that's all about me. Jared, you want to introduce yourself? I'd appreciate that.
You bet. Thanks, Troy. So I was born and raised on a 4th-generation row crop farm near Herman, Minnesota, which for those of you, if you remember back in the 90s, that was the Bachelor Mania capital. So that's where I hail from. From there, I went to NDSU, obtained my Ag Econ degree as well as a master's degree, and then interned with Ag Country for 2 summers, and then came on full-time about 5 years ago. So I'm excited to be a part of this.
Yeah, and Jared and I go way back. I mean, so I'm 55 years old, and Jared is less than 30. Pretty smart guy. He graduated and went through high school with my son, so I got to know him through that era. And I would just say he's one of those clean-cut A-plus students, and we're so lucky, in my mind, to have you as part of the Ag Country team. And I asked him if he'd be a part of this conversation because I think it's so important as we think about what folks in that 20 to 35-year age gap view of interest rates. They haven't been through a time of rising rates. Many of us, and our previous speaker talked about the average age of a producer being 57 years old. Most of us that have been around a while have been through some tough times. We've been through these cycles. You know, I can tell you it's nothing new. You know, it's nothing that we need to are panicking about. There's a lot of solutions, and again, I think what matters is being proactive and taking steps on each farm to do what you can to mitigate the threat of rising interest rates for your farm. So we'll get into that. Anything else we got to talk about from your childhood?
No, that should be good.
All right, so what's causing inflation? You know, we go back, and I think about COVID-19. And, of course, that pandemic caused governments around the world, not just in our country, but around the world, to take steps to mitigate the spread of the virus. You know, we can argue and debate all day on whether that was good or bad. It doesn't matter. That's what happened. And that shutdown of activity has certainly impacted supply. So I think about inflation, and so much is driven by supply and demand. So we think about that supply part of the equation. So COVID-19 impacted production of raw materials. It impacted production of things like computer chips. and all that kind of stuff. So the pandemic it really wreaked havoc on the economic cycle that we've seen and probably enjoyed for quite a long time. And again, when I talk about economics, we're going to talk a lot about the consumer view, if you will, more so or as much as how it impacts agriculture. But the pandemic was a huge piece. The shelter-in-place order, again, it decreased our workers' availability to get things done. And at the end of the day, I think back a year ago, I was at a conference at Newport Beach in California, and off the coast were all these ships parked off on the west, out in the ocean. And again, we had our loading docks without workers able to take care of that work. So that just wasn't a good thing, and it was a real big supply disruption, both from shipping and from production. The things that make it real for me, I'm part of the ag industry, but how I felt it, I remember going to the grocery store and picking up the normal groceries and getting to the aisle that normally had Kleenex and toilet paper. We didn't have any toilet paper. You think about that, and I hear stories of in the 80s how there were long lines for gas. And, I probably felt that we'd never see that again because our world's got it figured out and we're working better together. Well, guess what? The pandemic really changed some things, and all of a sudden, something as simple as toilet paper wasn't available. More recently, we've seen supply issues in the area of baby formula. So I have two grandkids, one of them just 2 weeks ago. But I can tell you, leading up to that, we worried about baby formula and how are we going to be able to feed this child that's coming into the world. And that seems to be in a better place today. But so anyway, layered on top of the pandemic, that was a big thing by itself. We have the Russian-Ukraine war and the conflict, whatever you want to call it. Of course, that's impacted shipping again, production. I think about Russia and how much fuel they supply to the world. That impacts our cost on the farm when we think about fertilizer and we think about anything that's connected to fuel in general. So that's been a big impact and something that's different. Dr. David Cole, Professor Emeritus at Virginia Tech University, will often use a quote that you have to think about black swans. So we kind of know what's happened. When we think about black swan events, they're things that were not expected. The pandemic was not expected. The war that we have overseas was not expected. There's some material that we read that gives us there's some philosophy or thought process that with the challenges in supply with food, especially on the Eastern Hemisphere, that there could be some food challenges on the other side of the planet. Well, if we have that, that can drive more issues, another black swan event. Now, we don't know if that's going to happen. We hope it doesn't. We hope everything goes away. But at the end of the day, there's going to be those types of things that happen that impact interest rates, inflation, and really things change because of that. So, again, we don't want to stay at that worldwide view, but we want to dive a little bit deep into some of these things and talk about it. And then at the end, we're going to really talk about what can you do on the farm to make sure that you're managing through some of these challenges that we have. So, Jared, I'm going to kick it over to you, the Federal Reserve. Tell us why in the heck, what are they doing to us? Why are they doing this?
Sure, sounds good. Like Troy said, we're not economists, but we're looking at this from our lender's desk as well as talking with our customers and how we can help explain what's going on and how we can help you manage that interest rate risk. So I'm assuming most in the room are at least somewhat familiar with the Federal Reserve. It's the central bank of the United States. They help set benchmark interest rates on short-term money. So how does that affect you? Well, what they do and try and help control inflation affects how the rest of the yield curve works, meaning you're going to buy a house, that'll help the bond market is going to be driven by, on the front end, what the Fed is doing. So simplistically, they have two mandated, their goals. Essentially, this is what drives their decisions, or is supposed to. They're supposed to be a non-political type entity that focuses on maximum employment and trying to keep inflation around 2%. Now, how well they do that is up to everyone's interpretation, and what drives inflation may not always be able to be controlled by monetary policy. So one thing in the last 8 months, you've probably heard a lot more about the Fed because they're focusing on trying to combat inflation through raising rates. So your operating line has probably gone up a couple percent, not a couple percent, at least some. I won't speak to the specifics, but and that affects you when you're borrowing the amount of capital we are to put the crop in. And so with that, people are worried about, okay, how often do they meet and how often are they going to raise rates? As we go here next week, they will meet, and the expectation is they will raise another 0.75%. Again, they'll meet in November, and they are most likely to raise again by 0.5 or 0.75%. Now, I'm basing that off of rate swaps, not my own personal opinion, so that's what the market is saying. With that, that all affects, again, how the rest of your borrowing costs work. So to the next slide would be
Well, before we jump to that, so really what I'm hearing is the Fed's mandate to control inflation is the driver of rate increases.
Correct.
Employment, I mean, any thoughts on that? It seems like everyone who wants a job has one. What would you say to that?
Right, and I think that's where we're seeing, and the Fed's openly said that, trying to pick apart what are the causes for the issues we're seeing in the economy. You know, the great resignation or the great retirement of baby boomers when their 401k was at highs they hadn't seen, and they went, you know what, well, let's move to the lake, or let's hit the road with an RV, or that sort of thing. And those are the type of issues that the critics of the Fed would say we're maybe leading down a path in some cases that we aren't basing our, we aren't following the mandate as well as we can because there's so many other external factors.
Well, thank you for that, because I just wanted to make sure we're clear that in my mind, employment has nothing to do with where the rates are going today, even though that's a mandate. But that long-term inflation rate, they're trying to manage it at 2%. And I know we're going to have a slide going forward, a couple slides from now, showing us where that inflation rate has been. It was pretty close to that 2.5%, 2% range for quite a long time. And of course, we've seen it change more recently.
So this is simply pulled from the St. Louis Fed, has tons of economic data that anybody can pull up. If you Google it, you can access all these types of charts and information. But what this simply is obviously back to 1960 through current today, where we were with Fed funds back in, obviously the anomaly is in the 80s, which again, in agriculture, that's not a curse word, but it's something that is in everyone's minds of, are we going back to the 80s? As you can see throughout time, when they're aggressively hiking or aggressively cutting, that's when we typically, it's hard to see on here, but that's when recessions occur. So that's the counter to trying to help keep the economic engine that's the American economy moving forward.
So I think about it this way. So graphs are tough to read. When I meet with farmers that are in that 55 to 70, 75 age bracket, some of them still actively working on the farm, they remember that peak in the 70s and 80s where we had interest rates in double digits. And of course, that was a tough period of time, not only because of interest rate, but where commodity prices and all those things were. What I think is interesting on this chart is that period of time on the far right of the graph, from 2008 through 2018. I think about our young producers, 35 and younger, if you will. They're used to 0% Fed funds rate. That's not normal. And, could you speak a little around, again, 2008, we had the housing crash, the bubble, if you will. That seemed to cause economic turmoil. The stock market, our 401ks didn't like it. The Fed took aggressive action. Right. And so that lasted a long time. And just recently, they moved it back up. But just any thoughts on that?
Yeah, I guess the biggest thing would be when you read the people that, again, are the true economists or those on Wall Street, the argument would be that we never saw the American economy get back to where it needed to be, where the Fed would have to intervene and raise rates. So obviously what that has done is asset appreciation has, again, whether it's the American home or those sorts of things, we've seen that in that period take off. And obviously prior to COVID, we were able to ratchet up rates. And one point would be that imagine what would have happened if we didn't have interest rates at least elevated slightly prior to COVID happening. We could have possibly been like Europe, where you had negative interest rates. Now, we'll never know, but
wish.
Yeah, but that's and that's crazy to even fathom and really think about putting capital into something and getting less back out just for security.
Well, again, what this chart does for me is, again, it gives me perspective of where we've been and really where we are now. And again, if you've only been in the farm business for 10 years or less, you might have this mindset that, gosh, rates are high. Rates are not high. Rates are still low. And so we have the opportunity to lock into rates today at historically low rates that aren't going to be material to your farm when you start thinking about an interest expense ratio and some of those types of things that financial advisors would get into and whatnot. So I think this is interesting. And I know the next chart we're going to talk a little bit more around longer term rates and the 10-year Treasury note. We won't spend a lot of time on that. But again, there is the Fed controls short-term rates to some degree through the Fed funds rate. Long-term rates are a little bit different duck.
Right, and I think one thing I would add for context is we're using these as illustrations. The Fed funds, prime is probably another typical interest rate product that people know of in the marketplace. But at the end of the day, it kind of all flows back to what is the Fed doing, and those indexes move accordingly in tandem. So this is just pulled off bar chart, a 10-year Treasury note. Again, look at the total rhythm of the graphic, meaning, okay, back to 2013, where we're at today. This was as of yesterday. I haven't looked today to see what 10 years done, but we're not at unprecedented highs. Again, in media and in the world, in all of our lives, headlines make things go. So when we talk about how much since the beginning of 2022, or even year over year, how much change we've had, it's easy to think we're at historically elevated or unprecedented highs when really we're not. So again, we were borrowing at a discount, arguably, from maybe what we should have been, and now we're, in my opinion, getting back to a more typical equilibrium. So
I want to get a little deep yet. This is kind of the subject matter that I think a lot of people say, gosh, big picture, inflation's high, rates are going up a bit, but they're really not high historically, and we just need to think about where we're going forward. But I've heard in the news about an inverted yield curve, and that's kind of deep, but I think of the relationship between these Fed funds, the short-term rates and the longer-term rates. Could you just speak briefly to that?
Yeah, and in simple, the premise of that argument would be that as you go farther out on the yield curve, interest rates should naturally be higher because you're going to expect more return for the more time you're locking in that investment or whichever side of the equation you're on. When it's inverted, historically speaking, that has been a precursor to a recession. Now, again, if the recession is caused due to other types of reasons, that may not be the case. So
yeah, and so we're not economists. We don't know if we're in a recession or not. I've heard some folks in the news and on the radio say that we are. If I looked at my 401k yesterday, I think we might be. It just doesn't feel too good. So, it kind of hits home and it feels real. So we have, I think, two more graphs, but this one I think is really interesting. And again, you can talk about it. The Consumer Price Index is a measure of inflation. It is inflation. And again, you have a red line and a green line. One includes food and fuel. The other one doesn't. So
right.
Let's walk us through this.
So I won't dwell on this too much. My college professors would love all this. But the fact of the reason I'm including the CPI is there was a CPI print yesterday for the August numbers, which is why the equity market and everything kind of had a little bit of a blip yesterday, is because the CPI came in higher than month over month than the market was expecting. So in details, fuel was down. Obviously, you've noticed the price at the pump is less. But overall, we're still at a point that in the market consensus was that we were expecting CPI to claw back, which essentially is what's the price of goods for an urban consumer. So that's another thing. What we're using here and what the Fed uses there's not a farm input index that we can say, okay, the farm inflation is at XYZ versus the common consumer. But obviously, they all work together in the market. So again, the only point I would make here as well is that food and energy is typically more volatile. That is why they have that, they net that out as well and call the other core inflation, where you net out food and energy, because that can sometimes skew because those are more reactive. So the only thing beyond that would be with this, there are different regional indices, and this is going to be the for the United States as a whole. So what we see here in the Midwest can be very different, somewhat different from the Southwest, depending upon where things are at and those sorts of.
And I just think big picture, here's what I get out of this graph. So I'm not a big graph person, if you will, but I look back in the 70s and 80s, and we had really high inflation, right? And then behind that, the Fed raised rates. And you talked earlier how the Fed was doing what they could to keep inflation around 2%. And what I see on that graph is we were around that 2% for a long, long time. In fact, it looks like from the 80s, I'd say 90s on, it just trickled down and was right around that 2.5%, 2%. So the Fed really was pretty much on track with that piece of what they're tasked to do. Right. And then only in the last, year and a half after the pandemic, in the pandemic, with the Russian-Ukraine deal that's going on, we have a pretty good spike. And, I like to think that our federal government, the Federal Reserve, the Treasury Department has more tools in the toolbox to help flatten that out quicker than maybe what happened in the 80s. Right. But again, I hear from producers that, again, are in that older age bracket that'll say, well, what comes around will come around again or something like that. So, we don't know where rates are going to be. We just know, what the trends are, and today the tools that you have available on the farm are better than what we had back then. So, is that fair?
Yeah, no, I think that pretty much covers it on that front.
So one last graph.
Yeah, this will be it. So I pulled this. This is the 12-month percent change. This is as of for August print, so this came out yesterday. You can see, again, for all items, which would be the 8.3 year over year, 11.4 for food, 23.8 for energy. Now, again, this is taking into account the decline in the energy, which was, like I said, on gas index was about 10%. Fuel ended up netting out to about 5% when all are included. So, point being, again, that in that time frame, arguably the index is saying you went and bought that same basket of groceries today versus a year ago, you're seeing about a 6 1/3% increase.
So this is really the last year.
Correct.
And so that graph showed us 50 years of data, which we saw the big uptick. It's high today. We don't know what next year is going to be, but again, we kind of know what the headwinds are. So, very good. So we're going to transition now to what can you do on the farm? So there's these external factors that you really don't have a lot of control over. I don't get to decide what the Federal Reserve is going to do. I don't have a lot of control on my own even together with inflation and what's going on. We heard, again, how world events can impact inflation. So when you get down to the farm, what can you really do? So before I start on that, I do want to say that before we start on that, every farm is different. Over my career, I've had the opportunity to train loan officers to give advice to producers that they work with, and it's fun to challenge them and just push them to the limit to think. And one of the things that I'll often do is I will share a perspective or a statement, and I would say, what advice would you give to the farmer in this case? And Ben Johnson, who's a loan officer in our Morris branch that's been with us about 10 years, I just love his response, and I could never get him to hardly crack a smile. But Ben would say this, he'd say, it depends. And I said, what do you mean it depends? Would you recommend they buy this piece of ground? Would you recommend they lock a rate? Would you recommend this or that? And he would just give me that kind of a deep stare and say, well, it depends. I said, well, okay, let's talk about that more. And anyway, his point was this. He said, every farm is different. The balance sheet, the buildup of that balance sheet is different. The type of farm that you manage and work on is different, the commodities that you grow. So the risk-reward profile of every operator is different. So we might give you some ratios and some suggestions on working capital, but it's not a one-size-fits-all. At the end of the day, what I like about working with Ag Country, and I think any good, strong ag lender is going to work with you as a producer, walk you through the Sweet 16 financial ratios, and really help you understand where you stack up to your neighbors and to the industry that you're a part of. That type of data, if you have good records, you really have a track record of how you are moving compared to others. And at the end of the day, I remember this goes back 15 years or more. I did a short survey of customers that I worked with, and this at the time was at the Morris branch. And, it was kind of a simple question. I wanted to know what they wanted out of me as a lender and what they were trying to accomplish on the farm. And some of the choices were profit, the way of life. And almost every farmer answered, I enjoy farming. I enjoy producing food. I like the lifestyle. This is what I want to do. It wasn't short-term thinking. It was always long-term thinking. And I think that was important for me to know and understand. So anyway, a couple other thoughts I have before we get too deep into it. I have a guy sitting in the front row here by the name of Tate Mosier with Ag Direct. And we were standing outside, and Tate goes, well, as you're talking about this, control the controllables. And it makes me think about Dr. David Cole, Professor Emeritus at Virginia Tech University, that often says, manage the manageables. There are things and choices that we can do to proactively manage our farm that is going to help us work through these tough times. So I think with that, I'll kick it over to you. You share what some of those things are, and we'll go from there.
I think when we sit here and the crop's about to come in and we're trying to figure out, okay, where are we at from a possible profitability standpoint, we have arguably strong commodity prices to provide us margin as well as debt payment and those sorts of things. And obviously, land market right now is hot. So the common question is usually, can we buy that quarter down the road? Or can we buy that quarter that's, would fit in well in our portfolio? And the thing I usually bring up is where we at, obviously from a working capital standpoint, because today's dollars, we're not going to be borrowing at what we were last year. So if we're looking at what are we going to need for operating capital, how are we going to manage that? Because essentially where we're at is trying to decide, does that return on that acre, whether it's, should we even be investing that in tile? I think that's one thing I'll just tee up on, is not being promoted by tiling, but in the valley, that is a hot topic that we hear from customers. And how do you quantify that return? And I think one thing is, we know we can most often get return on tile if it's a quarter, 80 or 40 that needs tile. Now, again, that's subjective, but we can quantify that return in an environment where interest rates are going to dictate more what we're doing than they did 2 years ago, when we could go out and lock 30-year fixed rates at sub 5%. And so reminding customers not to, we like to earmark debt sometimes. As a lender, I try and get people out of that mindset a little bit. So when you say we borrow $500,000 for that piece of equipment, well, in reality, what are the terms and what's the cost of funds? Because in profitable times like we're in, it's easy to say, well, let's prepay this debt. Let's, clean up this and do that. And well, when we start looking at what we're seeing, we're not going to be able to borrow that dollar at the same we had it borrowed 2 years ago.
Well, that's where I like to go right away. I always think about that per acre. I like to keep it simple. What's our cost of production? What's our per acre cost for seed, fertilizer? Going to be different. Chemical, fuel, interest expense. Again, rent, your overall land cost. And so I think about just the basics of financial management. We don't have to get complicated at times, but from your viewpoint, I think a cost of production and how that overall per acre, take a corn and soybean operation.
Yep.
I think back to what the overall cost average might have been last year compared to this year. I mean, is that up 10%? Is it up 20%? What do you see?
So I was looking last night and this morning. In some areas, I think we're, depending on where you're at from a fertilizer standpoint, there is pockets where if you had at least a decent amount of prevent plant, not that we like that, but in some cases, guys are going to pay a little storage on that fertilizer and going to be able to help balance that across their acres. But overall, I would say 15 to 20% is what we're probably going to see. Just based upon preliminary numbers, and again, depending on where you're going to be at. The other question of that is, can we, with this rail issue, the strike, I saw Reuters came out this morning, and 40% of the fertilizer in the United States is in a rail car at some point. So that's, especially for us up here where we're relying on rail, that's a huge piece of it. Now, again, not to hit the alarm quite yet, because hopefully they can get it negotiated out and we'll be fine, but those sorts of things that, again, with like inflation, it's not so much a natural inflation caused, but more so due to demand and logistical issues.
Well, and the reason I bring it up, this cost of production per acre, is when you start line iteming out all of different components of producing an acre of corn, for example, the interest expense piece isn't a huge part of it. But we can certainly manage that by doing what we can to fix rates in and that sort of thing. But we just don't want to get lost in that, if you will. But I think about overall risk management. In my mind, it is about business planning, building a cash flow projection. What does next year look like based on where commodity prices are today, where your production's been? And then we look at that, cost per acre for corn, beans, sugar beets, whatever commodity you're growing, and really enterprising those out and really understanding, how do I manage my risk next year? And so that sets the framework, in my eyes, for the next piece of that, which is layering in crop insurance to help protect revenue, layering in a marketing plan, and executing on that.
No, I think that's a great point. And the other thing would be, again, being cognizant of the additional capital we're investing into these crops as we look even back at, say, 2014 and what it took to grow an acre of whatever commodity at that time. It's, again, the interest rate creep is going to have, it's going to catch up to us a little quicker than maybe we would think due to the fact we're going to have that much more capital wrapped up.
I think, too, about tax management and how important it is to think about that as we approach year end. And, sometimes as we push income and expenses back and forth, we get kind of down to that month of November, December, and we just have a short window of time, 30 days, to really take some action to try to mitigate that risk. So let's say interest rates went up 2%. Well, if I didn't manage that tax obligation, that has even a huger impact. So I think about prepaying expenses where you can and all that. But again, what do you see normally our producers doing to make sure that they're prepared at year end with their accountant, with their tax specialist?
Right. And I think from an input side, we're seeing where that calendar date of when the fertilizer guy from the co-op or wherever, the seed guy, they show up earlier and earlier every year, and there's more and more of a, not an ultimatum, but as producers, we know that that's going to be more and more of a risk in terms of, can I get the physical possession of the product? And we saw that with Liberty, glyphosate, any of those chemistries where we can manage that a little better than the fertilizer, because not every farm, I would say the majority of farms, do not store their own on-farm dry product. So as far as tax management would go, most operators are aggressive at this point in terms of locking in those inputs. If they're not, there's obviously probably a good reason. If they are, typically they're forward contracting some crop or using the market tools available to them to manage some of that risk, because otherwise you're leaving one half of the gate open. But it's, as far as equipment goes, yeah, obviously in the last couple of years we've seen a lot more issues through that trading cycle for equipment. If you're a second owner type farm where you're getting that piece of equipment off, at 300, 400, 500 hours or 2 crops, whatever it may be, that whole cycle has been affected with COVID and other things, whether it's chips or labor issues, where that, like you said, you have to play. We're talking, October, you need to be looking at, okay, where are we at from a tax management need, or maybe with the way the economy is and the way the government is, tax rate, some people might say, let's chunk off a piece of it and pay it. Now, that's easy for me to say, but.
I always think of this, again, I worked with a lot of producers over the years, and what I think matters is sometimes folks like to focus on production, and they really look for a lender that has the expertise in agriculture that can really help them make good decisions. So I think really, in my mind, again, all of us are in a different area on our how much we enjoy digging into numbers. Generally, a good ag lender is going to understand these concepts, and they're going to help drive you in the right direction if you're willing to allow that and accept that advice. I think that's something that we definitely take a lot of pride in.
No, I would agree with that. One other thing I would point out is, as we get into this higher rate environment, and if there were to be multiple years where working capital gets depleted and we have to look at restructuring, it's going to be tougher due to the fact we're going to be taking out advantageous interest rates at whatever they may be and trying to price that above, and that's not going to be the case. It's not going to be an option.
Well, I can't believe how fast the time goes. My understanding is the clock is nearing the end of our conversation, but before we go there, does anyone have any questions that we can answer before we give some closing comments? Okay. So Jared, closing comments on
Sure.
you?
Yeah, no, I guess for me, the biggest thing is reminding producers and helping be there as a counsel and guide if there are questions on more macro pieces that as a producer we don't think about as often at the local level. But interest rates are going to become a bigger piece of the puzzle again, and managing that, knowing the cost of carrying that capital, whether it's if there's not advantageous input supplier type, if it's on your operating, what does that mean? How does that affect your cash flow? So staying aware and making decisions for the long term.
So do you enjoy your job in the lending business?
I do.
Well, I think we're lucky to have you, and I so appreciate you helping today. Again, your background with some of your economic education, I think brings just a tremendous amount of value that sometimes we don't always think about. And the more of that we can share with producers to help them position them on the farm, I think the better. So appreciate everything that you've done.
Thank you.
Again, Jared and I, we're with Ag Country Farm Credit Services. The Farm Credit System is a network of associations across the country. We focused on ag 100% of the time, the agricultural business. That's who we are. That's what we do. We do our best to hire experts that are not driven by profit, but are driven instead by helping producers succeed. Our mission is to serve ag in rural America. Our vision is to be a destination for success. That's what kind of gets me out of bed every day, gets me kind of jacked up to go to work and do what we do. Like I said, the part of the job that I love the most is working with producers, ranchers across our footprint, helping them make good decisions. And at the end of the day, together, all of us are part of an industry where we're feeding America, feeding the world. It's pretty important stuff. And, I think that's something that's important for all of us to remember and to be proud of. So,
I would agree.
So with that, I think we're wrapped up.
Farming today doesn't always feel the same way it used to. Then again, some of it feels all the same. Maybe it isn't so much the jobs that changed, but how they get done. Now that's a different story. Efficiencies are critical, which is why you need a lender who will find the right loan structure for a strong financial future. You need a lender to look out for your whole farm operation. Ag Country.